It happened without sirens, no breaking news banners, no emergency press conferences, no sense of urgency at all. In March 2023, while markets looked calm on the surface, the world's most powerful central banks released a short, coordinated statement. It did not announce a crisis. It did not warn of danger. It used one quiet word: precautionary. Behind that word was a decision that changed the architecture of global finance. The central banks of the United States, Europe, Britain, Japan, Switzerland, and Canada agreed to make their currency swap lines permanent, not temporary, not limited, permanent, unlimited, available at any time, in any amount, at a moment's notice. This was not new technology. Swap lines already existed. They had been used before, but only in emergencies, only during stress, only when something had already broken. In 2007, swap lines were introduced quietly as cracks appeared in the banking system. In 2008, they exploded into full use as global credit markets froze. They were described then as temporary, extraordinary, a bridge over troubled water. When the crisis passed, the public was told the tools would be wound down. They never really were, and in March 2023, the pretense ended. This time, there was no Lehman Brothers collapse, no stock market crash, no visible panic. And yet, the emergency tool was upgraded into permanent infrastructure, as if the fire department decided to keep every hydrant pressurized forever, just in case. The media barely noticed. A few financial outlets ran short articles. Most people never heard about it at all. There were no headlines asking why unlimited emergency liquidity was needed in a supposedly stable system. The word precautionary did the work of silence, but history gives that word a very different meaning. In finance, precautionary measures are rarely used unless risk is already visible to those in power. Central banks do not lock in permanent emergency access because they are optimistic. They do it because they no longer trust timing. They do it because when confidence breaks, it breaks fast. There is precedent for this. In August 2007, officials privately discussed liquidity shortages while publicly dismissing concerns. In September 2008, the global financial system nearly collapsed in a matter of days. The public learned about the danger only after the response was already underway. Again and again, the same pattern appears. Coordination first, reassurance second, shock last. March 2023 fits that pattern perfectly. The decision was not made by one country acting alone. It was coordinated across continents, different currencies, different political systems, different economic conditions, all agreeing on one thing. They needed instant access to each other's money, without limits. That kind of agreement is not built for normal times. It is built for moments when trust evaporates, when markets seize, when no one wants to be the last holder of someone else's promise. And that is the part never explained to the public. Currency swap lines are not about trade. They are about survival. They exist to prevent a chain reaction when banks stop lending to each other. When dollars become scarce, when the plumbing of finance clogs. By making them permanent, central banks quietly admitted something they could not say out loud. They no longer see crises as an exception. They see it as a recurring condition. March 2023 was not the beginning of panic. It was something colder than that. Acceptance. An acknowledgement that the system now requires constant emergency readiness just to function. The announcement passed unnoticed. But history shows that the quiet moments matter most, because when the response comes before the disaster, it means the disaster is no longer theoretical. It means someone, somewhere, is watching something the rest of the world is not. Listen carefully to what central banks have said since 2021. Inflation is temporary. Supply chains will normalize. The system is resilient. Everything is under control. Those words were repeated again and again, across countries, across continents. They were delivered in calm voices, behind podiums, supported by charts and forecasts. The message was simple: this is uncomfortable, but it will pass. But while those words were spoken publicly, something very different was happening quietly. Because central banks do not reveal their true beliefs in speeches, they reveal them in balance sheets, in reserve allocations, in infrastructure projects, and what they choose to build when no one is watching. And those actions tell a different story. If central banks believed inflation was truly temporary, they would have prepared for growth, investment, expansion, normalization. Instead, they prepared for disruption, which were breaks in trust. for moments when markets stop behaving the way models expect. This is not subtle. From 2021 onward, balance sheets expanded even as interest rates rose. Emergency facilities remained in place long after the emergency was declared over. Liquidity backstops were strengthened, not dismantled. Temporary measures quietly became permanent features. At the same time, public confidence was treated as something fragile. Language was carefully managed. Risks were minimized. Words like contained and manageable returned to official vocabulary, echoing phrases used before earlier crises. But behind the scenes, central banks behaved like institutions that no longer trust smooth outcomes. They invested in redundancy. They invested in speed. They invested in systems that can operate when other systems fail. This is the difference between theory and reality. In theory, inflation fades, rates normalize, markets adapt. In reality, confidence can vanish overnight. Liquidity can disappear in hours. Correlations can break without warning. Central banks have lived through this before. They have the transcripts. They have the scars. After 2008, many officials publicly admitted that their models failed. That assumptions about rational markets and orderly behavior collapsed under stress. That lesson never went away. So when inflation surged after 2020, central banks did not just fight prices. They fortified the system. They did not prepare for a soft landing. They prepared for turbulence. Look at where the money went. Not into long-term productive investment, but into buffers. Not into innovation, but into insurance. Not into growth narratives, but into contingency planning. This is why the contradiction matters. On the surface, the system is described as stable. Underneath, it is treated as fragile. That gap is not an accident. It is a warning sign, because confidence is the currency of modern finance. Once it cracks, no interest rate can fix it quickly. Central banks understand this better than anyone. That is why they work so hard to preserve appearances while quietly reinforcing foundations. But history shows that when words and actions diverge, actions are telling the truth. In the late 1960s, officials insisted the gold dollar system was sound while secretly bleeding reserves to defend it. In 2007, leaders spoke of contained risks while building emergency liquidity facilities. In both cases, the public message lagged reality. The pattern is repeating. Today's contradiction is not about incompetence. It is about timing. Central banks know that acknowledging fragility too early can cause the very panic they fear. So reassurance becomes policy. Silence becomes strategy. But preparation does not lie. When institutions stop planning for upside and start planning for failure, it means they see something ahead that does not fit the official story. This is why the gap between what they say and what they do matters more than any press conference. It is the first signal that stability is no longer assumed. It must be defended. There is one asset central banks return to when trust starts to matter more than growth. Gold, not stocks, not bonds, not currencies. Gold. In 2022 and 2023, central banks bought more gold than at any time in the last 55 years, over 2,000 tons, quietly accumulated, rarely discussed, almost never explained. This was not symbolic buying. It was not ceremonial. It was the largest coordinated shift into gold since the breakdown of the Bretton Woods system in the early 1970s, and it happened at the exact moment central banks were telling the public that inflation was temporary and currencies were stable. That contradiction is the story. Look at the buyers. China added hundreds of tons while publicly reducing its reliance on US dollar reserves. Poland made one of the most aggressive gold purchases in Europe, openly framing it as a matter of national financial security. Turkey bought gold while its currency weakened and trust eroded. India and Singapore increased holdings as global trade tensions and monetary fragmentation intensified. These are not speculative actors. These are institutions responsible for system stability. They all chose the same asset. Gold is unique for one reason. It does not depend on anyone else's promise. A bond depends on repayment. A currency depends on trust. A digital system depends on infrastructure. Gold depends on nothing. No counterparty. No issuer. No network. No electricity. It is final settlement. That is why gold disappears from official discussion during periods of competence, and why it reappears when competence becomes fragile. History makes this clear. In the 1960s, Central banks claimed the dollar was as good as gold, while secretly coordinating sales to suppress the gold price. The public was told the system was stable. In reality, reserves were hemorrhaging. By 1971, the system collapsed in a single weekend. Those who trusted official assurances lost purchasing power overnight. In the late 1990s, central banks sold gold aggressively, declaring it a barbarous relic. That sale coincided with peak confidence in paper assets and financial engineering. Less than a decade later, the global financial system fractured. To date, the behavior is reversed. Central banks are not selling gold, they are hoarding it. And they are doing so while defending fiat systems in public, while raising interest rates, while claiming monetary control. That is not coincidence. It is insurance. Gold does not generate yield. It does not stimulate growth. It does not support lending. From a textbook perspective, it is inefficient. From a survival perspective, it is unmatched. Central banks understand this. They have lived through moments when liquidity vanished and models failed. They know that in extreme stress, correlations break and safe assets stop behaving safely. Gold is what remains when trust evaporates. That is why gold buying accelerates before monetary stress becomes visible to the public. It is not a prediction of collapse. It is preparation for disorder. When institutions responsible for currencies choose an asset that competes with currencies, they are revealing doubt, not panic. Doubt. Doubt that inflation will be easily contained. Doubt that confidence will remain intact. Doubt that the current system will behave as expected under pressure. This is why gold buying matters more than any speech. Words are meant to calm. Gold is meant to protect. And when central banks quietly choose protection over performance, they are casting a vote, not against a single currency, but against the assumption that the monetary system will remain smooth, predictable, and trusted. That vote does not make headlines, but history shows it is rarely wrong. In 2023, something new appeared at the center of global finance, not on front pages, not in press conferences, quietly. The Bank for International Settlements, the institution that sits above all others, launched a project it called Finternet. The name sounded harmless, almost futuristic. A vision, they said, for the next generation of the financial system. But visions are rarely built in a hurry, and this one wasn't built for optimism. Publicly, Finternet was described as modernization, de-efficiency, innovation, a cleaner, faster way to move value across borders. The language was technical, dense, easy to ignore, until you read what it was designed to survive. Buried inside official documents were phrases that rarely appear in healthy systems. Financial instability, infrastructure disruption, operational continuity during stress. These were not theoretical risks, they were design requirements. Finternet was not built to replace the current system. It was built to function when the current system fails. That distinction matters. No one builds a backup unless they believe the primary system can go down. Not slow down, not wobble, go down. Throughout history, backup systems emerge only after faith in permanence is lost. During wartime, governments build redundant command centers. During nuclear escalation, they construct underground bunkers. During pandemics, parallel supply chains are planned. This follows the same logic. For decades, the global financial system relied on trust, layered on trust, payment networks, clearinghouses, interbank markets, all efficient, all fragile under stress. When they work, they are invisible. When they fail, everything stops. Central banks know this because they have seen it happen. In 2008, interbank lending froze in days. In March 2020, even the US Treasury market seized. The most liquid market in the world stopped functioning properly. These were not edge cases, they were system-level warnings. If Internet reflects what was learned from those moments, this is not about preventing crisis anymore. That language has faded. This is about surviving one. Prevention assumes control, survivability assumes limits, and central banks have quietly accepted that there are limits. The project's architecture emphasizes resilience over efficiency, redundancy over speed, continuity over optimization. These are not the priorities of growth. They are the priorities of systems designed to endure shock. The shift is subtle but profound. For decades, policymakers believed crises could be smoothed, managed, engineered away. After repeated failures, the mindset changed. You cannot always stop disruption, but you can plan to operate through it. That is what Internet represents. A financial lifeboat is not launched in calm seas. It is built when those in charge no longer trust the weather. And the most important detail is this: no public announcement explained why such a system was necessary now. No speech acknowledged fragility. No leader said the old system might fail. Instead, the backup was built quietly, technically, professionally, without drama. Which is exactly how institutions behave when they believe saying the truth out loud would do more damage than preparing in silence. This marks a turning point. From confidence to caution, from optimization to resilience, from prevention to survivability. And once a system is designed around survival, it means failure is no longer unthinkable. It is planned for. There is a difference between planning and rehearsing. Planning is theoretical. Rehearsing means you expect to need it. Since 2020, financial regulators have been doing something quietly, consistently, and with growing urgency. Every year, they run full system failure simulations, not tabletop discussions, not academic stress tests, real operational exercises. The participants are the core guardians of the system, the Federal Reserve, the US Treasury, and the FDIC. These are the institutions that step in when everything else stops working. The scenarios they practice are not mild. They assume the failure of multiple major banks at the same time. Not one bad actor, not an isolated mistake. Systemically important institutions collapsing together, across markets, under pressure. This matters because simultaneous failures are what turn problems into crises. In the 2023 exercises, the assumed trigger was simple and terrifying. A sudden loss of market confidence. No war, no natural disaster, just trust breaking. That is all it takes. Confidence is the invisible glue of finance. When it holds, trillions move smoothly every day. When it breaks, even solvent institutions can fail. Liquidity vanishes. Funding dries up. Markets freeze. These simulations are designed around that reality. They test how fast regulators can communicate, how quickly liquidity can be deployed, how resolution mechanisms activate when several institutions collapse at once. They assume chaos, not order. Speed, not deliberation. This is not academic modeling. Academic models ask, what might happen? Rehearsals ask, what do we do when it does? The distinction is critical. After the 2008 crisis, officials admitted that their stress tests failed to capture real behavior under pressure. Models assumed rational actors and orderly markets. Reality delivered panic, hoarding, and sudden freezes. Those lessons changed how regulators think. Now they practice the breakdown itself. They rehearse weekends when markets are closed and decisions must be made before Monday morning. They rehearse press coordination, emergency lending, resolution announcements, all the steps that must happen fast or not at all. This is the same logic used by militaries and disaster agencies. You do not simulate earthquakes because you enjoy imagining them. You simulate them because the cost of improvisation is too high. History supports this. In 2007, before the public understood the danger, internal meetings already discussed liquidity, stress, and contagion. Officials reassured the public while preparing behind the scenes. When the collapse came, it came fast. Today, the rehearsals are more explicit, more detailed, more frequent, and that tells us something important. Institutions do not devote years of effort to practicing scenarios they believe are impossible. They practice the events they fear arriving without warning. This is not about predicting dates. It is about acknowledging vulnerability. By rehearsing collapse, regulators are admitting that stability is conditional, that confidence can vanish suddenly, that the system no longer has the margin it once did. Publicly, this is never said, but rehearsals do not lie. They reveal a world where crisis is not a remote tail risk, but a recurring threat that must be managed in real time. When preparation shifts from prevention to execution, it means one thing: the unthinkable has become thinkable. And once institutions accept that, they prepare accordingly. None of this is new. What feels unprecedented today has a history, and that history follows a pattern so consistent it is hard to ignore. The first clear example appears in 1927. That year, central bankers from the United States, Britain, France, and Germany met quietly at the Federal Reserve Bank of New York. No press, no minutes released, no public explanation. The goal was currency stabilization. specifically to support Britain's struggling pound after its return to the gold standard. To do that, interest rates were pushed lower across borders. Credit was loosened. Liquidity flowed. Publicly, everything was described as stable. Privately, policy was coordinated to hold the system together. The result was not immediate collapse. It was something more dangerous. A massive credit bubble. Easy money flooded markets. Speculation surged. 2 years later, the system broke violently. The 1929 crash was sudden, not gradual. The Great Depression followed. The pattern repeated in the late 1960s as dollars flooded Europe and confidence in the post-war monetary system weakened. Central banks met quietly in Basel, Switzerland, home of the Bank for International Settlements. Their problem was gold. Officially, the dollar was still convertible at $35 an ounce. In reality, the math no longer worked. To preserve the illusion, central banks created the gold pool in 1968. They coordinated sales of gold to suppress its price and defend the crude dollar's credibility. The public was told the system was sound. Reserves were quietly drained. For 3 years, they held it together. Then, in August 1971, President Richard Nixon closed the gold window over a single weekend. The system they spent years secretly defending collapsed overnight. Currencies floated. Inflation surged. Purchasing power was permanently altered. Again, coordination came first. Reassurance followed. The break was sudden. The most recent example is still fresh. In August 2007, as cracks formed in the U.S. housing market, central banks quietly introduced currency swap lines. They were described as temporary, precautionary, technical. At the same time, officials publicly downplayed risk. Subprime was contained. Spillovers were unlikely. Swap lines expanded anyway. By 2008, those same tools became lifelines. Banks failed. Markets froze. Global finance came within days of collapse. What began as a quiet coordination ended as a public emergency. The lesson across all 3 episodes is the same. Central banks coordinate privately when they see structural stress. They reassure publicly to protect confidence. And when the system finally breaks, it does not do so slowly. It breaks suddenly. There is never a gentle unwind. There is never a smooth transition. The public is always told stability remains until the moment it clearly does not. This is why the present moment matters. Permanent swap lines, record gold buying, backup systems, rehearsals. These are not isolated decisions. They are pieces of a familiar sequence. History does not repeat exactly, but it rhymes with uncomfortable precision. Every time this pattern appears, the outcome is not immediate collapse. It is a delay, a holding action, time bought with coordination and credibility. And then, without warning, the system reaches its limit. What follows is never announced in advance. It simply happens. At the center of the global financial system sits one market, above all others, U.S. Treasuries. They are not just government debt, they are collateral. They are the benchmark. They are the foundation beneath banks, pensions, insurers, and central banks themselves. Trillions of dollars in global finance depend on the assumption that treasuries are always liquid, always tradable, always trusted. That assumption broke in March 2020. That as the world shut down, investors rushed for cash. In theory, treasuries should have been the easiest asset to sell. Instead, buyers vanished. Prices moved violently. Bid-ask spreads exploded. For several days, the safest market in the world stopped functioning. This was not a credit crisis. The US government had not defaulted. There was no doubt it would pay. The problem was plumbing. Dealers could not absorb the selling. Balance sheets were constrained. Liquidity evaporated. The market seized. The system froze around the asset designed to prevent freezing. The only reason it did not spiral into collapse was intervention. Massive intervention. The Federal Reserve stepped in with emergency purchases measured in trillions, not to stimulate growth, not to lower rates, but to make the market function again. It worked, temporarily. The episode was described as an anomaly, a once-in-a-century shock, a pandemic distortion. The public was told lessons were learned, but the structure did not change enough. In October 2023, the warning returned. During a routine treasury auction, liquidity thinned again. Yields jumped unexpectedly. Trading conditions deteriorated. The signs were familiar to those watching closely. Once more, intervention followed. Quietly, technically, without headlines. This time, there was no global shutdown. no visible panic. And yet the same failure mode appeared. That is what alarms central banks, because if the treasury market fails, nothing downstream works properly. Repos depend on treasuries as collateral. Money markets depend on repo stability. Banks depend on money markets. Swap lines depend on functioning collateral chains. Even emergency tools assume treasuries can be valued and exchanged. When treasuries stop trading smoothly, the entire financial system loses its anchor. This is why March 2020 was a turning point. It showed that safety is no longer guaranteed by size or history. It showed that liquidity is conditional. It showed that modern finance, optimized for efficiency, can break under stress faster than policymakers can react. And once a failure is observed, it cannot be unseen. Central banks know this. They study it relentlessly. They do not talk about it publicly because the system still depends on belief. But their actions reveal how seriously they take the risk. Permanent swap lines exist because treasuries can seize. Backup systems exist because markets can fragment. Rehearsals exist because confidence can disappear without warning. The treasury market is not just another market. It is the keystone. Remove it, and the arch collapses. That is why quiet interventions matter more than loud reassurances. They signal that the system is no longer assumed to be self-stabilizing. It must be actively supported, constantly monitored, and immediately defended. This is not about predicting a crash tomorrow. It is about recognizing a structural change. The safest market in the world has shown it can fail. And once that truth is accepted inside central banks, everything else they do begins to make sense. Because when the foundation cracks, survival becomes the priority. Not growth, not efficiency, survival. Modern finance runs on something more fragile than money. Trust, not confidence in growth, not belief in prosperity. Trust that tomorrow will look enough like today for the system to function. Banks lend because they trust repayment. Markets trade because they trust liquidity. Currencies circulate because people trust acceptance. Once that trust cracks, no policy tool works fast enough. Central banks understand this better than anyone. That is why they cannot speak freely about fragility, even when they see it clearly. Acknowledging weakness does not calm markets, it tests them, and tests can fail. History is filled with examples. In 1931, when doubts about banks spread in Europe, depositors did not wait for confirmation. They ran. In 2008, when Lehman Brothers failed, trust vanished in days. Institutions that were solvent on paper collapsed because funding disappeared. The lesson was brutal and simple. Markets do not wait for explanations. This creates a paradox at the heart of central banking. They must prepare for disruption, but they must not announce that preparation. They must build defenses, but they must describe the environment as stable. They must plan for loss of confidence, while insisting confidence remains intact. So they split their behavior in two. Publicly, they reassure. Privately, they fortify. Press conferences are calm. Balance sheets are defensive. Speeches speak of resilience. Infrastructure speaks of survival. This is not deception in the usual sense. It is containment. Central banks are managing expectations because expectations themselves shape outcomes. If enough people believe the system is fragile, it becomes fragile. Transparency, in this context, is dangerous. A central bank openly admitting uncertainty would not be praised for honesty. It would be blamed for panic. Markets would react first, analyze later. Liquidity would flee before nuance could catch up. That is why silence becomes a tool. Not silence in action, but silence in explanation. Emergency facilities are renamed. Backup systems are framed as innovation. Rehearsals are called routine. Language is softened. Risks are generalized. Nothing is denied outright, but nothing is emphasized. This approach has worked before. Sometimes, in 2008, authorities avoided full collapse by acting faster than public understanding. In 2020, massive intervention prevented markets from spiraling when fear peaked. In both cases, action preceded explanation. The danger now is different. The system has been saved repeatedly. Each rescue adds complexity. Each intervention becomes permanent. Each silence must cover more ground, and the space between public narrative and private reality grows. Central banks are not hiding because they are careless. They are hiding because they believe the system cannot survive full honesty. That belief alone tells us how delicate the structure has become. A strong system welcomes transparency. A fragile one manages perception. Today's system does the latter. Silence is no longer absence. It is policy. And when silence becomes policy, it means the truth is considered too destabilizing to share. That does not mean collapse is imminent. It means confidence is doing more work than ever before. And confidence, once lost, is the one thing no central bank can print. Taken one by one, each of these actions can be explained away. Together, they tell a clear story. Permanent swap lines mean emergency conditions are no longer exceptional. In the past, these tools appeared only when the system was already breaking. Today, they are built into the structure itself. That signals a world where stress is expected to return, not as a rare shock, but as a recurring feature. Gold accumulation sends the same message from a different angle. Central banks are not abandoning fiat currencies. They still issue them. They still defend them. But by increasing gold reserves, they are admitting something quietly. Long-term confidence in paper systems is no longer taken for granted. Gold is not about yield. It is about settlement when trust fails. At the same time, backup financial systems are being constructed. These are not upgrades designed for speed or convenience. They are designed to function when normal systems are impaired, when payments are disrupted, when infrastructure is strained, when markets fragment. That implies not certainty of failure, but acceptance of disruption as a real possibility. Then there are the rehearsals. Year after year, regulators practice scenarios where confidence vanishes suddenly and multiple institutions fail at once. This is not because they doubt the system today. It is because they cannot predict when stress will arrive. Timing is uncertain. Vulnerability is not. That distinction matters. Central banks are not acting out of speculation. They are not betting on collapse. They are hedging against it, the same way an engineer designs a bridge to withstand rare but catastrophic loads. Not because collapse is expected every day, but because when it happens, consequences are irreversible. This is defensive behavior. Defensive systems prioritize resilience over performance, redundancy over efficiency, insurance over growth. That is exactly what we see now. The global financial system is still functioning. Markets still trade. Banks still lend. Currencies still circulate. But underneath, the architecture is being reinforced in ways that reflect hard-earned lessons. Confidence can disappear faster than it is built. Liquidity can evaporate before policies are announced. And once panic starts, explanations arrive too late. Central banks know this because they have lived it. So what this means right now is not that collapse is imminent. It means the system is operating closer to its limits. It means margins for error are thinner. It means stability depends increasingly on coordination, intervention, and belief. These measures are not warnings meant for the public. They are precautions taken by institutions that understand how quickly modern finance can unravel. When emergency tools become permanent, it tells us stress is no longer viewed as temporary. When gold becomes a priority again, it tells us trust is being quietly hedged. When backups and rehearsals multiply, it tells us disruption is no longer unthinkable. This is not a forecast, it is a condition. The system is being managed not for a perfect future, but for survival through imperfect ones. And that shift, more than any headline, defines the moment we are living in now. The future central banks are preparing for is not a single dramatic event, not one crash, not one headline, not one clear moment where everything breaks. It is something more complex. Overlapping stresses, liquidity shocks that appear without warning, confidence that weakens unevenly, markets that function one day and malfunction the next. This is not the future of clean collapse. It is the future of friction. In this world, systems do not fail all at once. They strain, they glitch. They require constant intervention to keep moving. Prices still exist, but liquidity thins. Markets still open, but depth disappears. Trust remains, but only conditionally. Central banks are designing for that reality. A system that bends instead of snapping. One that can absorb shock after shock without total failure. One that can be stabilized repeatedly, even if it never fully heals. This is why permanent emergency tools matter. Why backups are built. Why rehearsals are constant. They are not preparing for a dramatic end. They are preparing for endurance. From the public's perspective, this kind of future does not arrive slowly. It arrives in episodes. A sudden market move, a weekend rescue, a quiet intervention. Then calm returns temporarily. Each event feels isolated. Together, they form a pattern. History suggests this phase is always quiet. The warning period never announces itself. It is only visible in hindsight, when actions taken in advance suddenly make sense. when tools built just in case become essential, when preparations once dismissed as technical details reveal their true purpose. This is how transitions happen, not with speeches, not with declarations, but with infrastructure. Central banks are not predicting the exact shape of the next crisis. They are acknowledging uncertainty itself as the threat. When timing cannot be trusted, resilience becomes the goal. The public may not experience this as a single moment of collapse. More likely, it will feel sudden anyway. A rapid shift in conditions, a break in assumptions, a realization that something fundamental has changed. That is how it has happened before. By the time the change becomes obvious, the preparation phase is already over. And that phase always ends quietly. No announcements, no countdowns, no final warnings, just a system that has been reinforced, rehearsed, and hedged ready, not for perfection, but for survival. The future they are preparing for is not one of certainty. It is one where uncertainty itself has become permanent. And in that world, the most important decisions are never the ones made in public. They are the ones made long before anyone is told why. Central banks do not predict crises. They position for them. They learned long ago that forecasting exact moments is impossible. What matters is readiness, placement, optionality, survival. So instead of warnings, they build defenses. Instead of announcements, they make adjustments, quiet ones. Their actions form a language most people never learn to read. It is not spoken in press conferences. It is written in balance sheets, in reserve choices, in infrastructure, in drills and redundancies. Gold is part of that language. So are backup systems. So are rehearsals carried out year after year. Each one says the same thing in a different way. Trust is valuable, but fragile. History shows this clearly. Every major financial break was preceded by preparation that made little sense at the time. Tools built just in case. Measures described as technical. Decisions framed as routine. Then the moment arrived. Not gradually, not politely, not with advance notice. The public never hears the real story before it happens. By the time it does, the positioning is already complete. The outcomes are already in motion. This does not mean collapse is guaranteed. It means stability is conditional. It depends on confidence holding, liquidity flowing, and belief remaining intact. And belief can change faster than policy. So the most important signals are not what central banks say. They are what they quietly do when they think no one is paying attention. Because history shows that what comes next is never announced. It simply arrives.